We have some big news for Nike stock investors as CEO John Donohue will be retiring and will be replaced by longtime insider Elliott Hill. Interestingly, Nike stock was up 7% following the announcement. This is the second major CEO change of a consumer goods company in recent months. The shocking change at Starbucks with incoming CEO Brian Niccol caused its stock price to jump by more than 20% when they announced that news. Nike, after watching its performance and stock price suffer in recent years, could use a shot in the arm. Nike's been one of my top-rated stocks in 2024 and one of the worst performing stocks on that list. Hopefully, this change will create better results for Nike shareholders. Regardless, I'll review the factors that led to this CEO change and highlight the primary strategic shift I expect from Nike. And finally, I'll let you know if I still think Nike is a top stock to buy.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so here was the news. Nike investors are running with the idea. Elliott Hill returning to the sneaker giant as CEO, trying to clean up the messes of outgoing tech-focused chief executive. Nike stock was up over 7% in pre-market trading. It was up roughly 6% before I started this recording. Now, what led to this? Why did Nike feel like this is an opportune time to make this change? Well, let's get into that. Well, in 2024, in its fiscal year that ended in May 31st, 2024, the company's revenues were flat, up just 1%. In the fourth quarter specifically, revenues were down 2%. Now, Nike is a company that usually grows closer to 10% annually. 7, 8, 9% is a typical year of growth for Nike. So to grow just 1% was especially disappointing. And then for fourth quarter revenue to be down 2% year over year when economic growth worldwide outside of China was relatively strong was very disappointing, to be sure. Nike management said, first the CEO said, "We are taking our near-term challenges head on while making continued progress in areas that matter most to Nike's future." The CFO said, "While we are encouraged by our progress, our fourth quarter results highlighted challenges that have led us to update our fiscal 2025 outlook." And by update, they mean downgrade. Instead of saying we downgraded, they said we updated. "We are taking actions to reposition Nike to be more competitive and to drive sustainable, profitable, long-term growth." You can see here I've had Nike rated as a top 25 stock to buy and a top 10 dividend stock in 2024, and I last updated that recommendation on July 2nd, reiterating that I still thought Nike stock was an excellent investment. So let's get into the meat of the underperformance. Nike direct revenues in the fourth quarter were down 8%. Nike Digital was down 10%, and Nike owned stores were down 2%. And if I zoom out a little bit and rewind, Nike had been doing a major strategic shift in recent years where they deprioritized partners, wholesale partners, and they increased their focus on Nike Direct. Their thinking was Nike is a strong enough brand to connect to consumers directly. We don't need middlemen. We don't need wholesalers in between us and our customers. That will have the added benefit of higher profit margins because we won't have to sell at lower prices to wholesalers who will then sell to customers and thereby generate lower profit margins for Nike. And on the profit margin side, it worked. Their profit margins are higher. You can see gross profit margins in the fourth quarter was up 110 basis points to 44.7%. And they said that this was due to strategic prices, lower freight costs and logistics costs, lower warehousing, partially offset by lower margin in Nike Direct, and unfavorable changes in net foreign currency. In other words, if you're going direct to consumer, your gross profit margins are going to be higher. You're going to sell at higher average selling prices, and you're going to have better logistics as well. You're not going to be delivering to several different suppliers in your logistics base, managing all of those relationships, etc. It's a lower cost way to operate. Now, overhead expenses decreased 9% to $3 billion, primarily due to lower wage-related expenses. Nike had been cutting costs and improving profit margins, but it's impacted growth on the top line. And shareholders are not happy about that because ultimately that leads to lower earnings per share longer term. It gives your competitors a foot in the door, which they might storm into. And they have. Competitors have made inroads against Nike in several markets, and it's been alarming to shareholders to see this. So that led to the CEO change. You don't often get more than one shot as a CEO when you're making a big move like this. So this big strategic shift from the previous CEO, from the outgoing CEO, it was the one big strategic shift that was his focus. Now, if it worked, he would have been praised and he would have gotten all of these bonuses, etc. But since it didn't work, he has shown the door, right? He's shown the door because you don't get too many chances at this. If you make this kind of a big, bold move and it doesn't work, then you're heading out. And that's what happened here at Nike. That strategic shift going direct to consumer was a big, bold move, and it seemingly is not working. So that leads me to the next point, which is what's the biggest thing to change with the new incoming CEO? It will be that strategy, I think. It will be the reintroduction to wholesalers, the building of those relationships again, the rebuilding of those relationships, developing trust again with wholesalers after the previous CEO kind of cut off a lot of wholesale partners, building that trust and getting them to sell Nike's products. Because while you might generate higher profit margins by going direct to consumer, you're also losing out on distribution of your product by good resellers, right? One of Nike's big partners were Macy's, Foot Locker, Warehouse Shoe Sale. And so these are relatively large businesses with large customer bases that go to their stores quite often. And if you don't have your products there and there's customers going into those stores, they're going to look at what's available and they're going to buy what's available. So if your product is not there, the shopper is going to choose something different. And that's what's been going on with Nike. This strategy led to decreasing market share, led to competitors gaining a foothold. And now I think with the incoming CEO, I think that's going to change. I think they're going to go back to that strategy. I think they're going to try and rebuild those relationships with wholesalers after this previous strategy didn't work. They're still going to focus on Nike Direct. That's still going to be a very important part of its business. But I think they're going to go back to wholesalers and develop those relationships again. Now, Nike's trading at a forward price to sales of 24 following this 6 or 7% increase today. And it's still relatively cheap according to the past valuations you've been able to buy Nike stock. So while it is facing near-term headwinds and challenges, Nike's brand is really strong. And I think a strategic shift will be enough to rebuild the company to its former glory. So I'm reiterating, I still think Nike is an excellent stock to buy. I still think Nike is one of my top stocks to buy. And I'll reiterate that recommendation on September 20th. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.